Can you hear it? Okay, great. Okay, so I'm very glad to be here today to do an abbreviated version of a 90-minute class that I do for older adults in Ocala, Florida, where I live now. And I've been doing this class for about 2.5 years. And so every semester, twice a year, I do this class. And it's a class that you'll always have students for because people are always getting older and getting to that RMD age. So I like to talk about RMDs as the mandatory flip switch. And some of you know I wrote a book called Flipping a Switch that talks about transitions in later life. And I do have about 4 copies left if anybody's interested in getting one later. But I talk about these transitions, and most of them, except RMDs, are voluntary. You know, you don't have to volunteer. You don't have to downsize. But you do have to take your RMDs. So it's the mandatory flip switch. Okay, one thing to keep in mind is, where are my baby boomers in the room? Okay, a lot of you. Baby boomers were the guinea pigs for all of this. Because prior to the late 1970s and early 80s, there were no tax-deferred retirement savings plans. 1978, the 401ks began. 1982 was the first time that IRAs were universally available to anybody with earned income. So that was just when the baby boom generation was coming of age and entering the workforce. So what I find when I teach folks in Ocala, where I teach my classes, is that these older adults, and I will preface it by saying that I live and that Foundation serves an affluent clientele. These are not people that are living in poverty by any means. But what these students of mine are telling me is 2 things. First of all, they never ever thought that in their 20s and 30s that they would have accumulated as much wealth as they have in their 60s, 70s, and beyond. They just couldn't comprehend it. And then the second thing that they were telling me, and I certainly agree with it because I heard it too, is because back in the 1978-82 era, there was no history on this. Everyone just assumed that when you got older, you got poorer. So the conventional advice at that time is, put the money aside now, you'll be in a lower tax bracket when you're older, right? And people are finding out not so much, particularly when the RMDs kick in. Okay, so some of the common questions that I get from students, and I kind of base the class around these, are how to calculate the amount that you have to take out. When do you take the first RMD? Do you take it at the trigger age, at 73 or 75 now, or do you delay it to the following year? And then there's the whole issue of the still working exception for employer-related plans, your current employer. Which tax-deferred accounts can be combined to calculate the withdrawal that you need to take? What do you do with the money? That's a common question that people ask. They've been in save mode for 40 or 50 years, and all of a sudden, they're decumulating. What do you do with the money? How do you calculate the taxes on the RMDs? And then, of course, methods of tax withholding. So what I did with this class is I developed what I call the 10 nitty-gritties, and I'm going to give you kind of a high-level view of what those were. When I teach the class, I obviously build in a lot more time for Q&A and some questions that I ask the audience and that kind of thing. Okay, but let's start at the very beginning. When people are working, the government gives you a choice. You can do option A or you can do option B. Option A is you don't have a tax-deferred plan. So you pay taxes on your current income, which you know, and on a certain tax bracket rate that you also know, whatever is in effect at the time. So right now we're under the rules of the Tax Cuts and Jobs Act. So you are working with known variables. You know your income, you know your tax bracket. You don't have any tax deferral, but certainly you can take whatever after-tax money you have and put it into some other type of account, like a taxable account. Okay, that's option A. Option B is when you go into a tax-deferred account. You are working with a lot of unknowns. You have no idea what your future income is going to be 40, 50 years in the future, perhaps. And also you have no idea what tax rates are going to be in the future. So you're working with those unknowns. So when you choose option B, as many people do, and it's a good choice, but you have to be aware that you're gambling. You're gambling with the fact that you think you'll have less income and that the tax rates won't be any higher than they are during your working years. And those are big gambles. And sometimes when people just say, I don't know what to do, I have no idea what I'll be doing 40, 50 years in the future, sometimes the best strategy could be just to hedge your bets and have some taxable and some tax deferred. And then you're covered either way. So something to think about, that people made these choices. So I always remind my students that you made a choice, years ago when you started funding these programs. But, and this is a big but, the one thing that is on the positive side is that they also gained from decades of tax-deferred compound interest. So there was a benefit to that gamble. So need to point that out to people. Okay, so as you all probably know, the RMD age, start age, has been kind of a moving target. So for anybody that was born in 1950 or earlier, you would have started your RMD either at 70 and a half or under the Secure 1.0 rules, 72. But then starting for people born 1951 to 59, their start age will be 73. And anybody born in 1960 or later, your start age will be 75. So that will be sometime, I think, 2033. So again, it depends on your year of birth. Okay, so a little bit about the nitty-gritty. Before I get into the nitty-gritties, a few other rules. One thing to remember is that you can take money out of tax-deferred accounts without paying that 10% penalty once you hit age 59 and a half. That hasn't changed. And I emphasize that in a lot of the classes that I teach, because what you really have is what I call the financial gap years. So between 59 and a half and 73 or 75, you either have 13 and a half years or 15 and a half years where you have a gap. Now you have to start taking the RMDs at your starting age. But before that, during those financial gap years, you may decide that you want to start taking withdrawals earlier. Nobody says you have to wait till your RMD age. And two scenarios that often come into play where people might start taking that money once they no longer have to pay a penalty would people who have an immediate financial need. They need that money to pay their living expenses. Or for more affluent people who want to stretch out the taxes over a longer period of time so they don't get hit with really big taxes once they get to RMD age. So some people decide to use those early financial gap years to start taking withdrawals from their plans then. Other people decide to just keep their money invested as long as possible. A couple reasons for that. You want to keep the tax deferral going for as long as possible. You want to postpone the hassles of having to do different things with your tax returns. You don't have to deal with it. You just kind of kick the can down for a little bit. Or a big one psychologically, and I wrote about that in my book quite a bit, is that it's really hard psychologically for people to take money out of their retirement accounts because you've been save for 40 years, particularly those of us in financial education. Because not only have we been save for 40 years, we've been telling all of our clients and students to save. So we don't want to look like hypocrites. And then, so we've been doing it, and then it's really hard to take that money out. So some people will wait until they're actually forced to take that money out. Okay, your required beginning date. This is an acronym that you'll see a lot, the RBD. That is the date that they absolutely drop-dead date that you have to start taking money out. And it's April 1st of the year following the year that you turn either 73 or 75, depending on your year of birth. So for example, if you are turning 73 in 2024, your RBD would be April 1st of 2025. However, you you have to keep in mind, and I'll talk about this in a little bit, that if you postpone, you'll have 2 RMDs in that starting year. For your qualified plans, your employer plans like TSP or 403Bs, anything like that, your RBD is the year that you turn 73 or 75, or if you're still working, April 1st of the year following the year of separation from the employer. Okay? So there's all of these kinds of rules. There's something called the still working exception, which we'll talk about a little bit more. Okay, so more about the RMD rules. Once you take that first RMD, all of your subsequent RMDs, following that first year, you will have to make withdrawals by December 31st of each tax year. Okay, so if anybody has to take an RMD for 2023, they have to get that done by, December 31st. So you're kind of running out of time. You really don't want to wait till the very end because it's the holiday season. Processing can take a little bit of time. So what you do is you would have your current age, and I'll show you the advisor chart in just a minute, and then you would have your account balance that's provided to you by your custodian, and the balance would be on December 31st of the year prior. So, for example, your 2023 RMD, which you have to take by the end of this year, will be based on the account balance on December 31st of last year. And you usually get that information from the custodian, like January or so. Now, you can take the RMDs at any time and in any way that you decide to do so. And this is where it really helps to be strategic, because one of the things you want to keep an eye on is how are the investments performing. 2022 has been kind of a roller coaster. We went up, we went down, we got up again. So, you kind of want to keep an eye on that. Many people will use RMD withdrawals as a way to do some portfolio rebalancing. So if you're heavy in one asset class, you might want to structure withdrawals to kind of lower that and kind of balance back to your target asset allocation. And then also financial need. So typically what will happen is people who really need that money as a retirement paycheck to live on, they might be taking monthly withdrawals just to kind of simulate a regular paycheck. People who have more than enough money to pay their bills from other sources, like a pension, Social Security, annuities, whatever, they might just decide to do it annually. So why do it monthly if you don't, if you don't need the money, just do it once and get it over with. I have a former colleague at Rutgers, and she just picked a date on or around November 15th. And she chose that date because she figured if the government gives an exemption, as they have, COVID, they suspended it, and there's been a couple times where the market's been really bad and they kind of suspend it. She doesn't want to have to redo it, and go back and, put back the money that she took out. And then she doesn't want to get caught up in the holiday rush either. So, you kind of pick a strategy that works for you. And the government doesn't care how many times you take withdrawals from your assets. All they care about is that you meet the minimum withdrawal that's required for your age and the account balance that you had. Okay, so what I want to do now is just go into the nitty-gritty. So the 10 different really nitty-gritty topics that relate to those questions that people often ask. So the first big one, of course, is how do you calculate the RMD? So what you need to know is your age, the age of the account holder, the beneficiary's age if the spouse of the person with the account is more than 10 years younger than the account owner, and I'll get into that a little bit more. And then you have to know your account balance, and like I said, that's reported by the custodian. December 31st of the prior year will be used as the account balance to calculate the RMD for the following year. And then basically what you do is you just take that account balance and you divide the divisor for a person's age into it, and that's the minimum amount that you have to take out. And of course you could always take out more. The government would love that because you're paying more taxes. The more you take out, the more taxable income you have. But the minimum is just calculated, it's just a math. It's just one little math, division example, and you've got the RMD calculated. Okay, so the government came out with a new uniform distribution table, the lifetime table, that's what they call it, that's used to provide the divisors that are based on a person's age that go into the calculation. And the last time they had updated was 2002, and then they did this revision in 2022 because life expectancies had gone up a little bit, and it's been 20 years since they made a revision. And they actually revised it prior to when COVID hit. So, life expectancy actually took a hit after COVID. But what they did is they actually extended it out to age 120, believe it or not. The prior table from 2002 only went up to 115. And so you can look at the divisors there, and obviously the numbers get smaller as the person gets older. So by the time you get to 120, if you should live that long, the divisor is 2. So basically, at that point, you're taking out 50% of whatever remaining account balance you would have at age 120. But I want to point out that the RMD percentages that are coming out of your accounts, those percentages are going to rise. And many people have pictured it as a graphic as kind of a wave, and then it goes down slightly like in your 90s. But it's a gradually increasing percentage. So when you start out at age 73, you're taking out 3.77%, just under 4% of your account balance. You get up to age 90, and it's 8.2%. And it just really goes up once people are in their 90s up, through 120. So that's something to keep in mind, that it's, it can be substantial. Let me give you an example. It can change a tax bracket. It can do a big number on your taxes depending on how diligent a person has been in their savings. So let's say we have somebody that turns 73 next year, and their divisor for age 73, come right out of that table that I just showed you, is 26.5. Well, if they had $10,000 in their account and you divide 26.5 into that, it's $377. Not going to make a big deal probably in your taxes. You get it up to $100,000 in the account, and then it's $3,774, rounded off. And if somebody has the holy grail of $1 million that people always talk about, trying to get $1 million by the time you retire, and you divide 26.5 into that, you're talking about $37,736. That's a lot of money to be adding to other income that you already have in later life: pensions, Social Security, annuities. I'm still working, so you've got job income. You start adding all those things up, and no wonder so many of my students are telling me that they have more money now in retirement than they did when they were working, because they have multiple streams of income coming from many sources, and the RMDs are becoming one of those streams. One thing I would just say, and I'll talk about this a little bit more, is that for IRAs, you do have some flexibility as to how many accounts you can draw from. You have to meet the RMD for all of your accounts, but you don't necessarily have to take money out of all the accounts. You just have to take the amount that you need to cover all your accounts from any one or more of those accounts, if that makes sense. So you have a little bit of flexibility, which helps with rebalancing and investments and that kind of thing. But one thing I always stress to people is if you can try to do some account consolidation before you get to RMD age, that can really make it a lot more simpler than trying to deal with all these different accounts. Okay, so you have to get this right, because obviously you're getting a report from the custodian as to what your account balance is, but so is the IRS. So they know how much you had. And the penalty actually has gone down. Used to be 50% of the amount that you should have taken out but didn't. Now it's 25%. It's still one of the largest tax penalties in the tax code. It's significant. But they also put in a little softener that if you can get it caught up, and they give you to the end of the second year following the year that you screwed up, basically, it can go down to 10% because they consider it timely corrected. So the penalties aren't as bad as they used to be, but they're still significant penalties. And of course, the IRS has all of its enforcement mechanisms, liens and everything else that they can do to make sure that you pay up. Okay, there is a special rule, as I mentioned before, if the spouse is more than 10 years younger than the account owner, then you're looking at the actual joint life expectancy of that couple, and you're using a different table. For people who don't have that issue, you're going to use the table that I showed you just before, the single life expectancy table. But there's also one called joint life and last survivor life expectancy. And that's the one that you would use when there's more than that 10-year age difference. And so that's a good thing because it stretches out the withdrawals a little bit further, taking into account that you've got that younger spouse. But one thing to keep in mind, the spouse has to be the sole primary beneficiary. So you can't have multiple beneficiaries if you're going to use that scenario. So some planning has to take place there. So again, the IRS has all of that information in their publications for tax-deferred plans. Okay, so then the second question, once you've figured out how to do the calculation, you need to figure out, okay, when am I going to take my first RMD? Am I going to take it at 73 or 75? And I'm using these ages because anybody who would have been at 70 and a half and 72, they've already done their RMD. So we're talking about people going forward. And again, I said you could take it on the required beginning date, which is April 1st of the year following the year that you turn 73 or 75. But should you do that? Should you postpone? Well, the answer, like anything else in financial counseling, is it depends, right? So some of the things that people are going to need to consider would be their health, their financial need, do they need that money, their income, and changes in income that they might have from one year to the next, and changes in their tax bracket. So what you really have to do to answer this question, and people have to do it on an individual basis, is just look at, okay, what's my income and tax bracket in the year I turn 73 or 75? What would be my income and tax bracket in the following year? And would it make sense? But again, keep in mind that if you do postpone to the following year, you're just kicking the can down, maybe 6 months or 9 months, depending when your birthday is. You're going to have two distributions that following year, because you'll have the one for the year that you turn 73 or 75, and the next year you'll be 74 or 76, and you're still going to need to take a distribution for that. So most people will not do that unless they really think there's going to be a big drop in their income from one year to the next. Okay, that still working exception. That's another thing that's kind of interesting, is the law allows you to postpone the RMD for your current employer's plan until the year that you retire. So remember I said on the panel yesterday that the fastest growing demographic percentage-wise in the labor force is 75 plus. So there may be people who are still working in their mid-70s and beyond. So they're older than RMD age, and they're still working full-time for an employer. So what the law says there is that you must take the RMD for the year that you stop working, even if you stop working on December 31st, which is common. A lot of times people will retire at the end of the year. However, you have your required beginning date is April 1st of the year following the year that you separate. So again, you have that choice whether you want to do it 1 year or the next. There are some provisos. You can't own more than 5% of the company that your employer, you're saying you're employed by. And you also have to remember that this is only for a person's current employer. The still working exception doesn't work for IRAs, nor does it work for any plans that you would have had with previous employers, from years by, because many people have multiple accounts from different jobs that they've had throughout their lifetime. But also keep in mind that delaying, you're just kicking the can down the road, and it will likely make your future RMDs larger. So let me tell you a story. when I was at Rutgers, I used to have people, faculty, call me up or email me and say, Barb, can I take you to lunch to pick your brain? So I got a lot of free lunches that way. It was kind of cool. And so I had this one professor, and he actually came with his wife. The two of them came. And he was 80 years old, and he was still working at Rutgers. But he was going to, separate from service. And he just had never done any planning. And so come to find out, and I always try to keep a poker face, but inside I'm saying, oh my God, he had maxed out not only in the 403B plan, but the 457 plan as well, because Rutgers was the State University of New Jersey, so you could be state government and university. Okay, so he had $5 million in these two accounts. Right. Still working exception, perfectly legal. It was at Rutgers, it was his current employer, but he had $5 million in these two accounts. And he was 80 years old. What do they say about the divisors, right? They get smaller, you get older. So I kind of did a, back of the napkin kind of calculation. We're looking at an RMD somewhere around $210,000, something like that. Now, he said he was leaving New Jersey. He was going to come down to Florida so he wouldn't have state income tax. But I thought, wow. And then, of course, he proceeds to tell me afterwards that his wife is related to the Johnsons that owned the Fidelity in Boston. They had all this other money, too. And I was like, oh, my God. So I referred him to some, excellent CFP colleagues of mine in New Jersey. And I said, you need to get professional advice. You need somebody that can model this all out for you. So just keep in mind, that's kind of an extreme story, but it just shows that if you're using the still working exception and you're just kicking the can down, you just got to be prepared for larger taxes later.
Not to butt in.
Yeah.
How do you make, my dad is using the still working exception.
Uh-huh.
He's not 73 or 75 yet, but he will continue to work that long.
Past there, yeah.
Because he's already 72, so right, he's on the law there.
Right.
And he's already got a pension and another pension, and I'm on him all the time, and my mom is too, and she's a CPA, and we just cannot, we have to have a plan for this money.
Right. It's hard because there's so many emotional
I
ties.
think his plan is we're going to make the plan when he's dead after he works till he's
Right. Yeah.
the plan there.
Yeah. A lot of it is that psychological feeling of loss that, when you see your account balance go down and you've been putting money in forever. It's hard. But maybe tell my story.
Yeah.
Use my story. I used to tell my students all the time, when I taught in cooperative extension, use the class, use my stories, and use them as kind of ways to start a conversation. So it's not coming out of the blue. You can say, I heard this story about this Rutgers professor. Maybe that will help. I don't know. But very often people can be persuaded through stories, because I'm sure that he paid more in taxes than he otherwise could have. He could have started during his financial gap years to start taking out some of that money and gradually taxing it instead of having this big chunk. So tell some stories, because they often work better than the numbers. Okay, number 4 nitty-gritty is combining accounts. And the law is very clear on this, that you are able to combine multiple traditional IRA balances, including rollover IRAs. You are able to do that. And then what you can do, as I kind of mentioned before, is you can take the required distribution for all of your IRAs from any one IRA or any combination of your IRAs. So most people will do this for portfolio balancing reasons. You want to keep your asset allocation at a certain level, and so you'll take from one account to kind of rebalance what you have in other accounts. So you can do that. However, you cannot combine IRAs with any other type of plan. 403B, 401K, TSP, everything else. You can't combine different types of tax-deferred plans, but you can combine the IRAs. Or, as I mentioned before, people can just start to consolidate their IRAs before they reach RMD age, and you'll kind of have the same effect doing that. Okay, There also is a caveat. How many of you are in 403Bs that work at universities? Okay, so you are able to combine 403B accounts, also known as TSAs or tax sheltered annuities, and you can take the required minimum distribution for all of your 403Bs from one or more of the accounts, so similar to the IRAs. However, you cannot do that with any other type of plan. So 401ks, if you have multiple 401ks, you have to take withdrawals separately for each one. TSP, would have its separate withdrawals, that kind of thing. You also cannot combine personal IRAs and inherited IRAs. Okay, you can't do that. You need separate withdrawals for each of those, nor can you combine inherited IRAs from different decedents. So, if you inherited from several different people, they all have to be separate RMDs for those. So, yeah, very, very specific rules on how to do this. Okay, this is the fun nitty-gritty. I kind of stuck it in the middle of the class. What do you do with the money? And the answer is anything that you want. You can use that money, many people have to, for living expenses, to pay your bills. You can put that money, again, the super savers that we were talking about, you can put that money, you can take it out of your tax deferred account and you can put it into a taxable account. Maybe an exchange traded fund or a mutual fund, something in a brokerage account. You can even put that money in a Roth IRA, assuming you have earned income, you're still working, and you meet the income limits. That catches a lot of people is if you're over those income limits. If you do that, that helps with tax diversification, which is a good thing. You can give that money, certainly, or you can just have fun with that money and just spend it on things that, bucket list items, for example, trips or things like that.
Barb,
Yeah.
if you're going to put it into a Roth IRA, since that money is being taxed when you take it out of the regular IRA, I can't imagine that it's going to get taxed again.
No, because the Roth would come out
Because it's
tax-free.
already been-
Sure, the
Okay.
Roth, yeah, oh yeah, you don't want to tax it again. No,
Right.
it would come out from the Roth tax-free. But again, for people who are in super saver mode and really just don't see themselves spending or gifting that money, they may want to, save it somewhere else. Yeah.
And one thing that a lot of people tend to have in their brain when they're doing their RMDs is, I have to cash this investment out, as opposed to you can transfer that stock to a different brokerage account.
Absolutely.
And you can still have the same stock.
Right, exactly. Good point. I was going to mention that, but I'm glad that you did. Yeah, so that's good. Yeah, you can do that. If you like the investment and you want to stay in it, you can just put it into a brokerage account, but you still have to take the RMD on the tax deferred plan. I developed this worksheet just to help my students kind of have a tool that they can use. So I put it in the handouts for the conference, so you have it to download. And it's just simply a couple lines where they put their balance in, or they name what the account is, they put the balance, they put the age-based divisor, and then they would have a column for withholding, how much are they going to take off the top for taxes, and then the amount that they would spend, gift, or put into a savings account, some kind of resaving. So just a kind of planning tool that people might have. Okay, RMD taxes. There's no getting around it. There's no capital gains tax rate on RMDs. They are taxed as ordinary income. So you're going to take the RMDs, you're going to add it to whatever other sources of taxable income that a person might have, whether they have income from a job, pension, Social Security, everything else that gets taxed, dividends, interest, whatever. And it's going to be taxed at the marginal tax rate, whatever it is. So it'll be anywhere from 10 to 37%. And as I said before, it's quite likely if you have large amounts of, savings, that your RMD can bump you up into a higher tax bracket. So that's where tax bracket planning really comes into play, so people can see what the effect is on their income, and then they might want to do something to try to offset that extra income. For example, I kind of have, I'm not at RMD age yet, but I foresee a time where I'm going to have to limit the income that I make from my business Money Talk to try to avoid some tax issues, which I'm going to talk about in just a few minutes. Okay, income tax withholding. So that's another issue, is you obviously have this source of income. How are you going to withhold the taxes on it? Most people will probably have it done through their custodian. So whoever's, the custodian for the plan is going to withhold a certain amount. A good way to kind of think about how much to withhold is to look at your effective tax rate. That'll give you a pretty ballpark percentage as to, a good percentage to take out for withholding. Some people will use the quarterly payments to the IRS. So 4 times, April 15th, June 15th, September 15th, and January 15th of the following year, you would make quarterly payments with the coupons. That's one way to do it. Another way might be to over-withhold somewhere else. If a spouse is still working or the account owner is still working, they might over-withhold on their job to cover some of the liability. Or you can do any combination of methods that work for you. But it's a really good idea to come up with a strategy. And I also teach the safe harbor rules and try to get my students to know those rules so that they don't get hit under withholding penalties. Okay, I mentioned that there's some other negative tax impacts. If the RMD is large enough, it's going to trigger 3 other things. It will trigger tax on Social Security benefits. Those are pretty low numbers now. I mean, they're $25,000 for a single person, $32,000 for a couple. Those numbers have never been inflation adjusted since 1984. Yes, they came up with those rules to tax Social Security in 1983 when they had that bipartisan commission. There has never been inflation indexing on that. So it doesn't take a whole lot of income now, 40 years later, to trigger tax on Social Security. So if people haven't been paying that tax, probably the RMD will get them over the limit for sure. But then the 2 other nasty things that come into effect too would be IRMA. IRMA is the income-related Medicare assessment charge. It's the higher earners Medicare premium. And there's 5 tiers of IRMA once you go over the standard Medicare premium amount. And it's for Part D and Part B. So that's based on your modified adjusted gross income. And that can trigger, so you're paying more for your Medicare premiums. And then another thing that often hits older adults when RMDs kick in is the net investment income tax. That's that 3.8% Medicare surcharge on investment income. That can hit you as well. The trigger for that is $200,000 of income for a single person, $250,000 for a couple. So yeah, you start triggering a lot of these different tax things that you never had to deal with in your younger working years. All of a sudden, it's triggering things that you have more income. Like I said, my students are saying they have more income now than they had when they were working. So I always try to include in my presentations just the point that it's important to have tax diversification. And for those of you who are not near Medicare RMD age, and those of you who are older who have middle-aged children, pass this along to them, because you can oversave in tax-deferred accounts, like the person at Rutgers that I told you about. What you ideally want to have is different types of retirement savings accounts that get taxed in different ways. So consider having some taxable accounts, what I call tax now. You pay the tax on the dividends, interest, and capital gains in the year that you earn them, and then you don't pay any other tax unless you sell those securities later. You have your tax later, which is your tax deferred accounts, and then you have your tax never, which is your Roth accounts and municipal bonds and things like that. So ideally, what you want to have is retirement savings in each of these types of baskets so that you are not just getting taxed all in the same way. So that's kind of important. Okay, so nitty-gritty number 8 was, how do you minimize these RMD withdrawals? Well, you need to do some strategic planning, and that's where I tell the story about the professor at Rutgers, and I encourage my students to seek some professional advice. They really need to speak with a CPA, even a tax attorney perhaps, financial planner, somebody who can run the numbers to see, when they max out on a particular tax bracket, and when they, go into the next tax bracket, and then look at mitigation strategies. Because what you want to try to do is not have the RMD bump you up into a higher tax bracket and pay more tax. QCDs are very popular. I actually started to do QCDs this year because I just recently hit 70 and a half. I was able to do that. Yeah, 70 and a half, that didn't change. Even though they changed the RMD age, they didn't change the QCD age. And what you do there is you contact your custodian and you direct them to send the money directly to the qualified charity. And if you do it before RMD age, you're getting assets out of your, account so that when you get to RMD age, they're not there anymore. Or if you are at RMD age, the money that you take out, you don't have to report it as an RMD because it goes to the qualifying charity, and you note that on your tax return as QCD. So it takes that out of your taxable income. So QTDs are a popular strategy. Certainly Roth conversions, I'm doing that too. And I've been doing it in stages because what you want to do with a Roth conversion, ideally, is not have it bump you into a higher tax bracket. You're kind of defeating the whole purpose of trying to reduce your taxes. So you want to do it in stages over a period of time, through all those financial gap years that I was talking about, to gradually convert a traditional account balance to a Roth account balance. And you can do a combination of those things. Okay, nitty-gritty number 6 is what about the beneficiaries of accounts? If somebody has been a super saver for their entire career, it's highly unlikely that they're going to deplete the account on the day that they die. It's just not going to happen. You're going to leave a balance. So you kind of have to look at, who you're going to leave that money to. You need to have some beneficiaries named for sure. And think about the fact that the inheritance itself, what people will receive, is tax-free, but the withdrawals are going to be taxed for the beneficiaries of the accounts. And there's different rules for the spouse and the non-spouse beneficiaries. I always caution people, too, to have contingent beneficiaries, have a plan B in case plan A predeceases you or for some reason disclaims the money or other reasons. Always good to have a backup person. So the rules are a little technical, but basically if the spouse is the beneficiary of the account, they can put the money into their own IRA, they can transfer it that way, or they can set up an inherited spousal IRA, and then the RMDs become based on the spouse's life expectancy, because at that point it's in their account and it's their money. The non-spouse rules, they have gone through so many changes in the last 4 years because we had Secure 1.0, Secure 2.0. There was a lot of confusion about the 10-year rule. What they basically did in 2019 is they eliminated the stretch IRA, where you could, base it on the, the life expectancy of the beneficiary, and you could have a 2-year-old child that had, long life expectancy. That all went away. And they came out with the rule that the account had to be distributed within 10 years of the death of the original owner. They did put in some exceptions, minor children, disabled, chronically ill people, things like that. There are some exceptions in the rule. But then there was a whole lot of question about, okay, so I have 10 years to take out the money. Do I have to take it out in years 1, 2, 3, all the way up to 10, or can I just wait until the day before the 10th year and just blow it out on one day? There was so much confusion. So when they went back to kind of finalize the regulations, what they came up with is that if the owner died before their required beginning date, it's not subject to RMDs in years 1 to 9. In other words, you can postpone it to year 10 and just do it all then. If the owner died on or after their required beginning date, in other words, they were already taking RMDs, then RMDs have to be taken in years 1 to 9. But it took them to 2022 to revise the rules. And people were like, wait a minute, 2 years have gone by, what do I do? So then they suspended it for 20 and 21, and then there was still confusion. They suspended it for 2022, still confusion. They suspended it for this year, and then next year they're going to start imposing RMD penalties if beneficiaries don't comply with those rules. rules. So it's been a very rocky road trying to roll out the rules for that. People can also make RMDs, beneficiaries of their accounts to entities. It doesn't have to be a person. So some people will put in their beneficiary designation that they want to have the money go to a trust or an estate or a charity. And in that case, the money has to be depleted within 5 years of the account owner's death. And what I encourage my students at that point to do is to consult a lawyer. If they're dealing with the trusts and the estate issues, they need to get some professional advice, okay? And if they're putting the money, if they're gonna make the beneficiary charity, what they need to do is talk to their family, because it shouldn't be surprise, surprise. Oh, by the way, you're not getting the IRA. The United Way is getting it. So a little cautions there, tax advisors for the trusts and communication is so important with family members. Okay, a little bit about Roth accounts. Roth accounts are funded with after-tax dollars, as you know. So with the Roth IRAs, there's no RMD requirement while the account owner is alive. Obviously, when there's beneficiaries, there will be, because the account owner can make the tax-free withdrawals. It's a Roth IRA. Roth accounts for employer plans, there's been a lot of change with that too, and a lot of confusion. What they finally came down with this year is that for this year, 2023 taxes that are due in April of 2024, the qualified employer plan Roth accounts are subject to RMDs. They're still non-taxable because obviously it's a Roth account after tax dollars, but they are subject to RMDs. Starting next year, there will no longer be an requirement to take an RMD from what they call designated Roth accounts, which are the qualified employment accounts that you have at workplaces. And this was new under the Secure 2.0 Act. So what they're basically doing is they're aligning the rules for Roth employer accounts with the rules for Roth IRA accounts, which people have been recommending forever. And it is still possible to roll a designated Roth account from an employer plan to a Roth IRA. If people want to do that, they certainly could still do that. Okay, so I'm just going to end up with 2 other slides because we're just at time. Some action steps that I close my class with when I talk with my students, as I encourage them to review their beneficiary designations, their primary and their contingent beneficiaries, and review their estate plans in general, to reach out to get professional help when needed, consider doing some consolidation so that they're not dealing with all these different types of accounts when they're older, getting help from their custodians. But remember that the custodian only has information about the account that they're managing. And if you've got multiple accounts, they may not be seeing the entire picture of your finances. And certainly getting a second opinion. And then I just mentioned that, when I do the class, I typically get really good evaluations because people are saying that it's a teachable moment for them and they're really getting information that they need right away. I'd like to close with what I say to my students at the end of the class. There's 2 reactions that people can have to RMDs. One is anger. The government has taken my money, I saved so hard, anger. And I always remind them that you took that gamble when you started your tax-deferred accounts. We talked about that at the beginning. But the other way that you can react to RMDs is gratitude and strategic planning. Be grateful that you have the account that you've been able to save through your working years, because there are so many older adults that are living hand to mouth. There was just a big article in the Wall Street Journal recently about how many baby boomers are homeless across the country. So be grateful that you have that money saved. But don't be stupid. Be strategic. Be strategic. You can be grateful and strategic and use some of those planning strategies that I recommended, QCDs and the like. So hopefully that's helpful, and all the slides and handouts are on the AFCPE platform. If you have any other questions, stay behind and I'd be glad to answer them. Thank you.